Sometimes it feels like people kind of piling on the housing market, right? You feel like that. I feel like that. Stubbornly high interest rates are there. Low supply and a slowing economy really have kept buyers out of the market. 7 cities now have outright year-over-year price declines in those homes, and that's as per the Case-Shiller Index. And to add insult to injury, as home prices have dropped again for the 5th straight month in July. So they're kind of coming down a little bit, as you can see. Now, throwing in Trump's lumber and cabinet tariffs overnight, and it might seem like things just aren't fair. Materials prices have gone up 34% since 2020, way outpacing inflation. The National Association of Home Builders believes with the addition of these new tariffs, the average house price in the country is going to go up by almost $11,000. Now, how are people supposed to get on the housing ladder? We need new people to get on the housing ladder to push everybody else higher, right? My next guest, he might have a few answers. Please welcome to the show Mr. Craig Bolanos. He's a co-founder and wealth partner at VestGen Wealth Partners all the way up in Chicago, where it still snows, if you ask me. Craig, thanks for coming on. It doesn't feel like the housing market they can't get a break.
No, we haven't caught a break, and we need to get houses moving again. The line I've been using on your shows is we need to get people to start trading in bunk beds for bedrooms because so much of the world is tied to housing. But Scott, this topic speaks to me. I've got a 24-year-old. He's married. They've launched in life. They're out on the East Coast, and the ability or the dream just to get into a starter home or a starter condo, it is so incredibly difficult. Some might say it's appalling and no easy answers, but lots of potential solutions.
Okay, that really intrigues me because without being too personal, what's the hardest thing about a new home buyer, somebody that's trying to get in the market? I mean, is it trying to come up with a down payment? Do they put the qualifications so high that it's almost too hard to even qualify for a mortgage? What's the biggest hurdle for, say, a 24, 25-year-old person that wants to get in on that market?
Simple. It is not the mortgage qualifications. It's not what we call financial underwriting or front end or back end ratios. It's affordability. But I'm not just talking about affordability of the sticker price of the home, Scott. I'm talking about the fact that everyone's graduating with collegiate debt, right? There's no doubt about it. I'll get a little personal. Our son Connor was fortunate that we had the ability to save through 529 plans. But his best friend in life, known as his wife, just like everybody else, is graduating with that undergraduate debt. And you put the cost of that debt on top of a car payment, on top of life, and it just prevents you or slows you down from being able to do that down payment, as you alluded to. And again, even if they have the money, there's competition out there because the competition isn't other people that looks like them. The competition are institutions coming in and buying up the inventory because rent and rent escalators have become such a profitable business.
So do you think that's one of the bigger impediments for young people to get on that housing ladder is actually the student loan?
Oh, I absolutely think it is. I think it's just so much harder to launch into life today. And that doesn't mean this next generation is soft. They are not. I'm very proud of both of my kids. They're durable, they work hard, everything else. But I'm at that point in life now where I look at my 24 and my 22-year-old and I say to my wife, Leslie, all the time, are they going to have the same opportunities that we did? Yes. Are those opportunities going to take longer to incubate, though? Most certainly. And what's going to be the disruption from artificial intelligence that comes with it relative to employment? But sticking on your housing point, Scott, it's just that difficult, whether it's college loans, high interest rates. I don't think it's financial underwriting. I also think a little bit of it's priorities. I mean, young people today love experiences, travel and leisure, meals and entertainment, and there's just additional pressure for that. Call it social media. And I think as a result of that, it's a different framework, a different set of mind, and who knows? There's a lot that goes into this, Scott.
Yeah, I get it. And like old people like me, my first mortgage was, I think, 7 3/4. I can't remember, but I do remember clicking my heels going down the road after I got it because at the time it was like, it was in London. I think it was a time it was a 30-year low, Craig, and I felt fantastic. But you know what's really changed between that 7 3/4 interest rate mortgage and today is the asset price. I wasn't borrowing that much money, at that rate. So that made my payment reasonable. But since, say, the great financial crisis of 08, 09, when we poured a bunch of money into the economy, and then what we did in 2020 with COVID and the money that we put in there, that inflation has just torn a hole in that whole idea and really ramped up these asset prices. So now that 7.75%, mortgage that I brag about, like, why can't you afford that? That was my first mortgage. Well, you have to look at the asset price, which is probably 4 or 5 times greater than it was back when I had my mortgage.
No, yeah, that's exactly right. I mean, I remember our first condo, 246 Jennifer Lane. I won't tell you what unit number it was, but we had an 8 and 7/8 mortgage. So it's not the interest rate; it's the fact that that condo now retails for 460% more than it did back when we bought in the 90s. Yep, that's real math because I've done it for other media appearances. So you're right; it's all about the asset price. I think what's going to be interesting is what are we going to do with all the Class B and Class A commercial vacancy that's there, and to what degree does the market embrace a transformation of some of that into multi-tenant, multi-use facilities to go ahead and get the supply working so that we can find a way to break this cycle of constantly raising prices.
Yeah, because that's going to be an issue, because in order for those asset prices to come down, people are going to have to suffer their personal net loss to their own wealth. And I don't know if that's, they don't want that to happen. And I'll argue this, too, with places like where you're at in Chicago, by de facto, they're involved in the real estate market, too, because the last place that they can raise money to run their government, their municipalities, is by real estate tax. And they don't want to see real estate really go down too much because they're not going to have any money to run the municipality, correct?
No, that's exactly right. You and I talked on your show very adeptly 2 weeks ago about the crisis in Chicago of underfunded pensions and liabilities. And you know what, Scott? You can't raise property taxes any more than they currently are, because people in the Midwest, people in Chicago proper in particular, you've essentially got 2 mortgages, one to the lien holder, the bank who gave you the funds, and then you got to pay for the house a second time over through property taxation. And that's not enough to right the city of Chicago's finances. So it's a great topic. Lots of moving parts. And I think as long as we make progress on all of the parts, that's the supply, that's the rate, and putting people in a position not to come out of undergraduate with too much student loan, we'll eventually start seeing this economy reshape and housing being more accessible to the next generation. But for this generation, it is what it is. You got to find a way to adapt, improvise, and overcome.
Perfectly said. I couldn't have done it better myself. Always great to have you on the show. Can't wait to see you again next week, Craig. Craig Bolanos, he's co-founder, wealth partner at VestGen Wealth Partners up in Chicago.